And when you talk about traditional forms of investing, stocks, bonds, real estate are all inversely correlated to a rise in rates. This is a difficult time to position yourself. I think it's a time for people to realize that return on your money is not as important right now as return of your money. Maintaining purchasing power is really, I think, what's very important. We are seeing a trend that's quite remarkable, actually. We are seeing a drawdown of metal off the London Metals Exchange, the COMEX market, being backdoored by the commercial banks out of the ETFs at a level that I have never seen in 30 years, ever.
Get ready to brace yourself for an investment revelation that's shaking the financial world. Traditional forms of investing like stocks, bonds, and real estate are facing a challenging dilemma as rising interest rates take their toll. But wait, there's a game-changing trend emerging that's leaving experts baffled and investors rushing to make strategic moves. Unprecedented withdrawals of precious metals from the London Metals Exchange and COMEX market are grabbing headlines. And it's not your ordinary traders making these bold moves. The biggest players in the financial arena are paving the way for a radical shift towards alternative assets. And here's why you need to pay attention. When discussing traditional forms of investing such as stocks, bonds, and real estate, it becomes evident that they are negatively affected by rising interest rates. This creates a challenging environment for positioning oneself. Instead of solely focusing on the returns on investment, it is crucial for individuals to recognize the significance of preserving the purchasing power of their money. Intriguingly, a notable trend has emerged, marked by a considerable drawdown of metal from both the London Metals Exchange and the COMEX market. Commercial banks are discreetly withdrawing metal from ETFs at an unprecedented level, something I have not witnessed in my 3 decades of experience. This trend suggests that the most well-funded, well-informed, and successful traders worldwide are favoring alternative assets. Commodities like gold and silver have become the preferred choice for many investors, not only because of their potential, but also due to the removal of counterparty risk. There's a significant shift happening with large-scale withdrawals and possession of physical deliveries from the COMEX market and the LME. This is an extraordinary development, as deliveries used to represent only a small fraction of the overall volume in these markets. The actions of the most affluent investors shed light on the significance of this trend. In a single day, these wealthy individuals took possession of a remarkable 41% of all the physical kilobars available in the COMEX market. Interestingly, this is not a typical preference for big banks, as they usually deal with 100-ounce bars. The emergence of a group referred to as the others on COMEX, dealing with kilobars instead of the typical 100 or 400-ounce bars, has caught the attention of the financial community. A weekly report called The Commitment of Traders traditionally showed the positioning of commercial banks and hedge funds referred to as specs, but now the others have appeared. These sophisticated private investors, believed to be sovereign wealth funds and family offices, have amassed significant power in the market. In a short period, an astounding 175 million ounces of gold have been withdrawn from the COMEX market in kilobars. This suggests that major players in the financial world foresee unsettling times ahead and are taking delivery of their assets. At the same time, silver is experiencing an unprecedented decline, raising questions about who is behind the large-scale withdrawals and where the metal is being directed. The prevailing theory is that the biggest money in the world, with their ability to anticipate market movements, is engaging in strategic front-running, exploiting the fraudulent price on COMEX to their advantage. Gold and silver, beyond their value as hedges against inflation, are distinguished by their lack of counterparty risk. By removing their metal from these exchanges, investors mitigate the risk of being dependent on someone else's liability. Furthermore, this trend is mirrored on a global scale, as the rest of the world has also been amassing precious metals. There is now a call for a new price-setting hub in Moscow, which challenges the long-standing perception perpetuated by the West. The situation indicates a significant awakening to the value of these commodities and highlights the underlying changes in the global financial landscape. The prevailing belief that precious metals are necessary, and one should stick to traditional Western-based assets like stocks, bonds, and real estate to maintain financial stability, is now showing signs of fracture. Massive withdrawals from these exchanges, unlike anything witnessed before, indicate a shift in the financial landscape. In light of these developments, the question arises, where should one invest their money? Fixed income options guarantee a negative real return, making them unattractive. Even equities that traditionally perform well in times of rising interest rates may not be the ideal choice due to the current state of the bond market. which has reached the end of a 30-year bull run and still offers negative real returns. In the past, people sought refuge in fixed income assets during tough times, transitioning from risk on stocks to risk-off bonds. However, this approach is no longer viable in today's market conditions. Despite the common notion that gold doesn't yield interest, it surpasses the -5 or 6% return that is being suggested amid inflation concerns. As we enter an unconventional period, traditional assets require a fresh perspective, and unconventional decisions may be necessary to navigate the changing financial landscape successfully. I have personally maintained nearly 100% of my investments in precious metals. While it might not have always seemed like the best decision, it has given me peace of mind, and I sleep soundly every night. As this investment cycle nears its end and the dust settles, I believe people will reassess their views on traditional assets. At present, I firmly believe that traditional assets are not the optimal choice. Although there may be differing opinions, I choose to follow the lead of the world's most influential investors. Over the past 6 years, I have observed them accumulating physical precious metals and divesting from other options. When analyzing inflation as a whole, it becomes crucial to consider that the inflation numbers we are presented with may not entirely reflect the true situation. There appears to be a vested interest in showing us inflation figures that significantly understate the actual rate of inflation. Organizations like the National Bureau of Economic Research provide valuable insights into this matter. In July, the Washington-based think tank released a report regarding inflation, revealing that when measured by the CPI, it was at 9%. Interestingly, they compared it to the 13.6% inflation experienced in June of 1980 using today's metrics and found that the adjusted figure would still be at 9%. This suggests that our current inflation is likely at least 50% higher, if not more. The historical perspective on inflation is noteworthy, dating back to Roman times when they deliberately reduced the silver content of coins used for payments to soldiers and others. Throughout history, politicians have consistently favored inflation over austerity, driven by their vested interests. This realization brings to light the ongoing impact of inflation throughout the ages and underscores the tendency of those in power to prioritize inflationary measures for their own gains. Not only does the government tend to downplay inflation, but it also actively seeks to create it. The current target of 2% inflation is hailed as a positive outcome, but I question why we consider that to be good. In my view, a -2% inflation rate would be more favorable, as lower inflation translates to a higher standard of living for everyone. The Federal Reserve seems to lack the determination to address inflation adequately. If we examine the historical response to a high inflation rate of 13.6% in 1980, then Fed Chairman Paul Volcker took decisive action by raising the federal funds rate to a staggering 19.75%. Such a move demonstrated a commitment to combat inflation vigorously. However, the situation today presents a real challenge. The Federal Reserve's balance sheet has grown exponentially, reaching $9 trillion, with all of it tied to interest rate-sensitive investments. This has resulted in the suppression of interest rates and the creation of an environment where dealing with inflation becomes increasingly complex. The situation we are facing has led to significant distortions in asset prices, creating a challenging landscape. From my perspective, it appears that the Federal Reserve has no intention of taking decisive action against inflation. If left unchecked, it might lead to hyperinflation, which is a far more severe outcome than a depression. As interest rates increase, the interplay with stocks, bonds, and real estate will create a deeply impactful experience for people in our country. The Federal Reserve seems reluctant to confront this situation, possibly due to the potential repercussions of raising rates. The problem of inflation looms large on a domestic level, and the only apparent solution is to raise interest rates. However, this action carries the risk of destabilizing the economy to an extent that most individuals are not prepared for and do not fully comprehend. Get ready to break free from conventional thinking as we navigate the ever-changing financial landscape. The time to act is now. I've personally placed nearly 100% of my investments in precious metals, and my peace of mind and sound sleep every night are testament to its potential. Let the world's most influential investors guide your path. As inflation numbers keep us guessing, it's crucial to dig deeper and question the narrative. Don't be left behind in this monumental shift. The question is, will you stay bound to traditional assets that may not withstand the storm? Or will you make unconventional decisions that pave the way for financial prosperity? The choice is yours.